you ask an audience, hey, the market does 10% over a long period of time. Is that a good return in any given year? And I think the answer that most people will give is not yes. It's, well, it depends.
What were the other options?
It depends, because what were the other options? I don't want 10% if 10% was the worst option.
Exactly.
So, we're stuck in this narrative. There's no way out. There is a way to navigate it successfully.
Yeah.
But there's no way to stop this from happening in our brains. It's just...
It's a great point, Jake. You think about we've had solid returns the last 3 years, really good returns in the U.S., and people go, yeah, but I just want NVIDIA.
Yeah, but.
But if I had put it all in Bitcoin, I could be retired right now. Or, I haven't looked up Bitcoin in a couple of days, so,
Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
Welcome to The Informed Investor, a show brought to you by Dimensional Fund Advisors, a global asset manager bringing financial science to investing. Today's topic is investor behavior. What are some of the behaviors that come into play in the decisions we make when it comes to our money? I'm Mark Ochner. I'll be joined today by Jake DeKinder and our special guest, Scott Bosworth.
Thanks, Mark. Thanks
Scott,
for having
welcome
me.
to the
Thanks,
show.
Jake.
So, Scott, you've
Good
been
to
at
be here.
Dimensional around 30 years or so.
Almost, yeah.
Right? You started out in the portfolio management group.
I did.
You led a group in the sales team, and now you oversee a group of speakers.
I do.
They go out and speak at Dimensional events, industry conferences, really all around the world. So it's great to have you here today. Scott, this is something that's been quite a hobby for you for a number of years. How did you get into this being a very personalized hobby for you?
In 2009, I set out to create a presentation that maybe relied less on the traditional dimensional. This is the evidence. This is the T-stats. These are your statistics. These are your probabilities. Now go have a successful investment experience. And to talk a little bit more about investor behavior and how it feels and connect more with the emotional side of things. And that presentation and that work has evolved over the past 15 years, and I'm still doing it today.
Let me read a couple of headlines, and then we'll dive into it and get into some of the findings that you had there. And, of course, Jake, I'll want you to weigh in on this as well. All right, a few headlines here. The cost of chasing trends, what data teaches us about investor behavior. And then this one I really like. Why investors sell too soon, hold too long, and regret it later. So, Jake, I'm going to come to you, and then we'll go back to Scott.
Mm-hmm.
But, a lot of times we talk about... On the show, we've talked about the emotions, fear and greed, but then there's some specific behaviors that actually do come into play and impact decisions we make.
Yeah, and one of those headlines you read I thought was really interesting around this sort of what does the data tell us about investor behavior? And I think about it a little bit like people know, eat your vegetables, exercise, and yet they still don't do it. People know that smoking's bad for you, and they still smoke cigarettes. People don't do it in every aspect of their life, so why would you possibly think when it comes to money, somehow they're going to make these perfectly rational decisions?
Right.
Walk us through, I guess, some of the key behaviors you've come across in evaluating the research out there in this space.
Well, so Wikipedia has a page now. I mean, they've had a page for years that lists all the cognitive biases, and when I checked it a few weeks ago, there were 245 on that list. So it's a fairly robust.
That's why I don't get into this space. Yeah. It's way too complex.
It just means that we're all really messed up in the head, is what it means.
Well, what it actually means, I think, is there's been so much research on this now, and the academics are all over it. So they're coming up with new and clever names for different, unique sort of findings that they've uncovered in the research. But to me, it kind of comes down to basic principles. The survival instinct, that underpins quite a few of what we call these biases. And they're not unhealthy to have. You would want them. But survival instinct, and I like to say, look, nobody likes to be wrong, right? We don't like to make bad decisions that turn out, that turn out wrong. We don't like to be in situations we can't control, and we don't like to get hurt. So we have all these psychological defenses that we've developed over however long to make ourselves feel better when that happens. Now, the survival instinct ones are not the ones that you would want to correct, but you want to have some way of acknowledging them when it's unuseful to apply them. But there are others, these what we call attention biases, the illusion of control. People will think they can time the market, and that can kind of control how the markets behave. But those attention biases are a lot easier for us to have kind of the ability to say, okay, I can have some life hacks or something to apply to my investment sort of, call it the recipe. And I can check in with those every time I'm thinking about making a decision.
Well, Scott, let's highlight a couple of these biases and then maybe give us a definition, an example of how it applies to investing. I think one of them is hindsight bias, but I'll let you kind of take it from there.
Of my favorites of the 245 that are currently listed in Wikipedia, I would say there are certain ones that are far more relevant to us as investors. And one of the ones I kind of start with is this idea of hindsight bias, right? There is an old saying about hindsight. What is it? Hindsight is
2020.
Hindsight's 2020, right? So hindsight, what does that mean? That means, well, when we're looking at the past, we know exactly what happened. We know exactly what transpired during, keep it to investing, transpired during any good market, bad market, what have you. So we feel like there's this certainty around, I know exactly what happened. Now I'm going to attach this narrative to why we got the outcome we got. And now it's going to make me feel, even though this sounds like a weird trick, but it's going to make me feel like the future is now going to be easier to predict. So I'm going to start looking for those same signals that maybe fit the narrative of what we lived through, and I'm going to start applying them to the future. And that really derails successful investing. This idea of hindsight bias, it is to me the most insidious of the biases when it comes to having a successful investment experience. If that continues to pollute the decision-making process for most investors, that's more often than not going to lead to very suboptimal outcomes for people. Related to that is this illusion of control, right? So that bias is you can probably make this switch pretty easily with that illusion that I can predict what's going to happen. That gives me this illusion that I can somehow control markets, right? Right now, we've had a really good run of equity returns, particularly in the U.S., for the last couple of years. And, yes, there's a lot of headlines that you all cover about the anxieties around being at all-time highs, and we've covered that. But to me, it's almost like people are upset that the market has done well. Why? Why are they upset that the market's done well? Because they didn't put all their money in the parts of the market that did exceptionally well. It's almost like, if you've ever played roulette, it's like putting your money on red and winning because red came up, but then being mad that you didn't put all your money on 12 red because you would have made a lot more money had you done that. And people can't. Now, gambling is not a really good analogy for us in most cases, so take that for what it's worth. The metaphor doesn't completely work. When you think about investing, you want to be diversified. We're not making bets with our money, but these biases are very similar to what you see in gambling or sports betting or sports in competition and life, marriage, that sort of thing. So those two linked are, I think, very powerful and very important for people to understand and be aware of as they're making investment decisions for the future. Because we can't make investment decisions for the past. It doesn't work that way.
So would an example be, hey, you mentioned the U.S. has done really well recently from a return perspective, and maybe a year ago an investor says, emerging markets is due. It's ready to have a good run. And It turns out last year it did have a very good run. Is that a hindsight bias to say, I knew it, and then now I have confidence to say I can predict what's going to happen going forward?
Yeah, I mean, there's pattern seeking going on. I mean, that's another thing that gets covered quite a bit. So if it's, we're looking at the hindsight bias is also related to pattern seeking in that we're looking for some sort of narrative or some sort of signal that's going to tell us about what's going to do well in the next short-term period of time. What that might be a few months for some people. It might be a few days for some people. It might be a short period of years for some people. But that pattern seeking, it's like, Mark, if I had a coin and I flipped a coin in front of you 6 times, let's say, or 10 times, and like you saw me, I flipped it 10 times and you saw 8 heads. Even though you are a smart person and you know that a coin does not have a brain, doesn't have a memory, there's part of you that's going to think, well, tails is due.
It's
right?
due. It has to be due.
It has to be due, right? And you're probably not going to bet any money that tails is going to come up more frequently than heads because you're smarter than that. But we all get tricked into that pattern-seeking behavior with a random event. We think there's going to be this reversion to the mean, but that's not what happens with a coin because a coin doesn't have a memory. It is a very simple but incredibly complex thing for people to grasp that look, there's no memory there. So, and people say, okay, that's a fun experiment that psychologists can do. But I say, go back to roulette. They show you what the past spins are on a roulette
There's a reason
wheel.
they have it up there.
They have it
above,
up there because they did an experiment years ago, the casinos did, and more people gambled, and they gambled more money if you showed them what the past spins were. So we're just wired that way. There's no getting around it. There's only awareness, and it requires a constant reminder of that awareness to make sure you're not falling prey to these biases where it's going to hurt you as opposed to help you.
What would the bias be where we're all anchored to something? Everybody individually is anchored to something. Like I sort of tend to think this is going to happen. So when we read headlines, we sort of go to the ones that align with how we think and sort of ignore the ones that don't align with how we think. Is that a bias, or is that just...
Oh, it's a confirmation bias. So this is one of those, this is not an encapsulated bias. This is more of, I think of it as more of an attention bias. So this is just a bias where we like to feel good. We want to surround ourselves with people that think like we do. So we consume information and we join friendship groups where people have sort of the same beliefs that we do. And that just makes us feel better. It tends to polarize us as well, which is the downside of that. And that's a social thing. I'm not talking about social or politics. We're talking about investments on this episode. So as it comes to investments, that, seeking out information that may not support your prior beliefs is a really healthy thing to do. Doesn't mean you're going to change your behavior based on that, but it will ground you in terms of the narratives you're consuming and sort of the anxiety you might have about whether we're in an all-time high or whether there's a recession coming or whether this stock is going to do well or do poorly.
One thing I want to pick up on what Scott said, which I thought was really good. I loved your example there of when you said, well, I bet on red and red came up, but I didn't bet on red 12 red, right? And I think that's really applicable to what a lot of financial advisors have to deal with, where you achieved a good rate of return for the year. You're on track for your goals. In fact, this rate of return is what we baked into the financial plan. And yet investors are like, yeah, but my neighbor got X return, or yeah, but this asset class did better. And it's really tough sort of just saying like, you captured red and red keeps you on track for your goals. You don't even have to worry about the 12 part of it, but people go there all the time.
Well, I do presentations all the time, and I think you do too, Mark, where it's like you ask an audience, hey, the market does 10% over a long period of time. Is that a good return in any given year? And I think the answer that most people will give is not yes. It's, well, it depends.
What were the other options?
It depends, because what were the other options? I don't want 10% if 10% was the worst option.
Exactly.
So, we're stuck in this narrative. There's no way out. There's no way out. There is a way to navigate it successfully.
Yeah.
But there's no way to stop this from happening in our brains. It's just...
It's a great point, Jake. You think about we've had solid returns the last 3 years, really good returns in the U.S., and people go, yeah, but I just wanted NVIDIA.
Yeah, but. Yeah, but.
But if I had put it all in Bitcoin, I could be retired right now. Or, I haven't looked up Bitcoin in a couple of days, so,
The other one, Jake, you highlight too is, there's a tool for the job. And we think about, let's just say in this case, it's stocks. And you think, well, the goal of stocks is to grow our wealth over whatever our horizon is, 30, 40 years. Yet we get so emotional around a one-year performance. Let's go back to 2008, for example, where maybe it's down 40%. Mm-hmm. It's really painful. Yeah, but I'm worried about 30 years from now. So do I really even care that much? I mean, emotionally, it's easy to say it, but emotionally hard to sort of let go of that.
When you're in the moment, right? Yeah. That's the tough part, right? It's the same thing we said earlier, where it's like, yeah, you say you can stick it out when you're down 30% until you're down 30%. Yeah. Let's see what happens.
You don't know.
Well, and we talk about long-term a lot, and you can look at a period with hindsight again, where your end year is really bad. But if you go back and say, well, what was your 30-year return with that really bad end year, it's a pretty good return. Mm-hmm. If you had said in 30 years prior to, say, 2008 or something, hey, you're going to get 9 or 10% in your stock portfolio over the next 30 years, most people are like, great, okay, so I'm going to reach my goals. The problem is, at the very end, you lost 40 or something like that. You had a really bad outcome at the very end, and you weren't planning for that, right? I mean, emotionally, that is incredibly hard to withstand, which is why people do risk tolerance questionnaires. It's why they don't put all their money in the stock market. They have balanced portfolios. They have multiple asset classes, and it changes through time. Risk tolerance, it's like, Jake, you were saying this earlier, can you withstand a 30% down draw or drawdown? And someone goes, yes, I can. And then the 30% drawdown happens, and they freak out, fire you, and put all their money in gold, right? So it's like,
Yeah.
it can you actually do it when it happens is a question that, we're always trying to answer for every investor.
I always go back to, hey, as an investor, I'm worried about X, Y, or Z at this time. Okay, great, I get it, but 3 years ago, what did the market do? If you're like, I don't remember. I'm like, 3 years from now, you're probably not going to remember
That's right.
what the market did.
That's a
with
really
whatever,
good point.
Or
whatever
what the crisis
thing
is
is
at the
going
moment.
on, the
Yeah.
crisis thing.
You freak out in the moment, but then you ask people, like, what was the crisis 4 or 5 years ago? And they're
I
like, "Don't
want
know."
to. Sorry, I didn't mean to interrupt. I want to touch on one other thing that we didn't touch on, which is this idea of, but sometimes people are right. I mean, they go back to irrational exuberance in the early 2000s or the Big Short narrative of 2008. I'm sure somebody saw COVID coming and probably got out of the market. So there's success stories, but there's a great quote, and I can't remember who it was attributed to off the top of my head. One of you might remember. It's the market can stay irrational longer than you can stay solvent. And I love that quote, and I reference it quite a bit in my talks because, these people that maybe get it right might have been saying that for years before they got it right? So you have, the old saying goes, even a broken clock is right twice a day, right? Somebody who says the market's going to crash, every year they say the market's going to crash, they're going to be right. What about every 6 or 7 years, depending on how you define a crash? So be careful of those narratives. They're going to sort of crystallize that hindsight bias because that will also happen. And a lot fewer people are actually as right as you think they are than what the media might suggest. It turns out.
Let me ask you this. You mentioned sort of the survival instinct. Give us an example of what that means. And is that connected to then the chasing patterns? Do those things go together?
Yeah, I mean, it's famously said, how many data points does a human being need to extrapolate a pattern? They only need 2, right? Like where we are now, and give me one more data point, I'm going to make an extrapolation. And that can go both positive and negative. But survival instincts, I mean, there's examples of this. Losing money feels like getting hurt, right? So there's a danger element to losing money. So our instinct is to, if there's bad news, I'm looking for a signal, right? You talk a lot about signal and sort of outcomes. In the financial markets, we get a lot of negative signals. So we're constantly being taught that our survival is in jeopardy. So we're constantly making decisions to try to mitigate the amount of danger we're subject to. So that is why people sell too early or they bail out on markets at the wrong times. They aren't able to stick to their plans. That's the survival instinct I'm talking about.
I mean, we're here at Dimensional, right? We're a very sort of rational, data-driven, research-based firm. And a lot of our founding is sort of in the empirical camp of academia, right? But then you've got this behavioral camp that we're talking about today. I mean, in your opinion, are those kind of two broad areas? And then a question for you, how can they coexist?
Efficient markets and behavioral finance, they've both been recognized in the academic community. There's Nobel Prizes on both sides of that debate. I don't look at it as a debate, right? I mean, there's the work on the empirical work on how markets work and the data we see about like what price informs in terms of expected returns and stocks and bonds and securities around the world. That's all super useful. But the analogy I like to say is that tells you how to build a really good car for your journey. It doesn't tell you anything about how to drive the car. And so behavioral finance and psychological research into economics, that focuses a lot more on behavior and driving the car. So I tell audiences, I say, you got to do both right. You can have the perfect portfolio, but if you don't stick to the plan, you're not going to have a high likelihood of being a successful investor. Consequently, you could be a really well-behaved investor, but you have all your money in a single stock, right? You're very disciplined, you're very aware of your biases, but you don't have the right car. So to me, getting both of those right is super important.
I love what you said there about sort of the empirical camp and then the behavioral camp. And I think a lot of that also sets up where a financial advisor comes in. I mean, kind of this objective third party, because to your point, even if we know that we have these things that are going on with our emotions, that are going on in our head, we have all of these biases, the ability to be aware of them, but then execute rationally in really tough times when things get choppy is really hard to do. I mean, that's the role of the advisor right there.
Yeah. on that note, and I think that's a really important subject to bring up, as I'm going through the list of biases, there was one that kind of caught my eye, and I hadn't heard of it before, but it's called the G.I. Joe fallacy. And so there's this paper in 2022 by a Harvard and Yale academics, and they get this. I'll give the punchline first. The punchline is, being aware of these biases is a very small part of the battle. Like, you have to have an ability, a plan to combat them or to sort of put them in check. And the G.I. Joe reference comes from a 1980s Saturday morning cartoon. I'm sure I watched it when I was a kid at one point. But I guess at the end of these episodes, they always had a PSA announcement, and it would say, "Now you know, and knowing's half the battle." TII. And these academics sort of like seized on that nostalgia and said, well, actually, knowing's not half the battle. It may be 10% of the battle or 5% of the battle, but the real battle is not knowing about it, because lots of people know about this stuff and still cannot help themselves when the what hits the fan and anxiety levels are very, very high. So I love that they sort of parse those into two different sections, right? There are certain biases that are sort of these encapsulated biases, and these are the ones, they're just hardwired. These are the survival instinct ones that you cannot get rid of. And then there's attentional biases, and attentional biases are ones where they're like illusion of control. You can do things to help yourself recognize when you're engaged in a bias like illusion of control. You're trying to control an environment that you really can't control, and you're spending a lot of time, effort, and possibly money trying to control something you can't control. This is where an objective third party comes in. This is where a professional advisor who, amongst the laundry list of things they do for clients, managing the behavior is one of them. They can point that stuff out for their clients, and they do all the time. We all have heard so many stories about advisors keeping clients from making really bad decisions at times of really high anxiety.
Well, and to that point, I mean, we hear all the time, well, not all the time, but sometimes investors will push back and be like, is this financial professional, is this advisor worth the cost, whatever that fee may be? And we know that you go back to March of 2020, you go back to the great financial crisis back in 08, 09, right? I mean, just keeping clients disciplined through one of those time periods is worth its weight in gold, and that fee is definitely justified.
Well, you made a comment too that I thought was interesting early on about when our portfolio goes down, we lose money. Like it's almost a physical pain. And you're talking about this idea of, hey, we know stuff with our health. It doesn't mean we always do it. So I think this behavioral stuff is just as important in our day-to-day lives as it is in investing.
Yeah.
Right? I mean, this idea of there's overconfidence, loss aversion. We try to find patterns in life. It's not just investing. It's everyday
If
living.
anybody played sports growing up, there's a reason they're sports psychologists, because a lot of these biases you apply when you're there on the field or you're on the court or you're on the course or whatever it is, right? I mean, all of this stuff, this is not just specific to money. These things are going on in our head every single day.
Yeah. I mean, it's how we're wired. I mean,
Yeah.
we're human beings, which is kind of makes this all inevitable. So having a plan for it is really useful, and it's what most advisors spend a great deal of time building.
I was just thinking overconfidence in relationships too. Like I
Do
go
you
to my
want?
wife.
Is this going to be like marriage counseling, doctor?
Yes.
What do you want to unpack?
I'm sure I go to bed and see. I'm like, man, I am just killing it as a husband. I'm feeling good right now. She's like, what are you talking about? Like you're in the doghouse.
Betsy's
in the
never
doghouse.
said. She's never said you're killing it as a husband.
I'm pretty sure not. In my mind.
No, I mean, Ken talks about it a lot in his Equilibrium Markets narrative, where he says overconfidence is the number one bias that shows up in all the literature. So it's kind of where everybody leads with. And I like to say, there's varying degrees. Some people have more of it than others. But, kind of as you're thinking about humanity, you kind of want some people to have a lot of overconfidence. I mean, that's how we innovate. That's how we take risks. That's how we get, we move ahead as a species, I guess, if you want to get really wonky. But, so overconfidence is just part of the human condition. And some have more of it than others. There's no pill for it. We wouldn't want to take it even if we could. So I think it's okay, Mark, that you think you're a great husband, even if Betsy doesn't always agree.
Well, thank you, Scott.
Yeah. And you know what? When you think that way, you feel better. And a lot of this stuff is psychological defenses, not about survival. Some of it is about survival, but a lot of it is just, when we make a bad decision, we have these psychological defenses that say, Well, now that wasn't my fault. That was this externality. Something over here caused me to make that bad decision. So that's called attribution bias. And then you also have the opposite, which is when you made those first option trades all those years ago, way before you were Dimensional. What did you think? You probably thought, I am so smart.
Yeah, absolutely.
Like, look at those great trades I made. I'm going to be so rich if I keep doing this. So overconfidence is great. It makes us feel better, but there's a different side to all these coins, and they can lead us into bad paths on an investment and a marriage basis, if you want to put it that way.
Attributing the mistakes to externalities and the overconfidence sounds like stock picking managers right there.
Well, I guess you look back at it all and say it's absolutely helpful to be aware of the literature and some of the biases, and everybody will have their own different biases. And then what do you do about it? And you guys talked about that. Get some professional help, get an advisor. They do a lot for you, but also they're independent emotionally when it comes to either the greed side of it or the fear side of it, which we're talking about there. And then the last thing here, and I think Ken French, you alluded to him earlier, but he does a nice job with this theme of don't evaluate the quality of your decisions by the outcome. Go back to the decision you made at the time of the decision. Did you make it with the information available at that time? Did you make the best decision you could make? And that's independent of the outcome. So I think that's helpful for investors too, to sort of anchor to that one as well. All right. Well, thanks everybody for joining The Informed Investor. We appreciate your time, and we will come back on a subsequent episode and talk about private credit. We are hearing a lot more about that in the headlines. We'll come back and talk about that in more detail. Thanks everybody. Have a great day.